Us trader and investor types are a solitary lot. So for us to shelter in place and to have social distancing is maybe not as difficult as it is for others. But why don't we shelter in place together and with appropriate social distancing and talk about the markets? What could be more fun than that? So let's take a break. Let's get together. Let's talk about these very crazy markets. And I want to show you some charts that I've put together that I believe you will find interesting, possibly fascinating. So with that, welcome to Power Charting. I'm Bruce Fraser, your host. We recorded this on March 19th, and with the speed of the markets, I want you to know this is being recorded approximately mid-market day. And this is for original broadcast on March 20th. So with that, what are we going to do today? I have a very interesting analog for you that came to me, and I'll talk a little more about that in a minute. Then we're going to do PNF studies. If we have time, I'm going to sort of keep track as we go, maybe some unique breadth indicators, and then sector and industry group analysis with the idea here that we want to look for and have the proper tools to be able to identify, find a proper cause, a cause of accumulation, a cause of redistribution, so that we want to be able to have a good toolkit for that, something we talked about last week. So here, searching for a cause, these are two accumulation schematics. Both are just slightly different. We here in this one, we have a spring, and over here we have an last point of support in phases C. And so this is the last testing area before a rally, but we're nowhere near that. As a matter of fact, I want to show you a really fascinating chart that sort of illustrates where the markets are right now. And so let me get my markup pen and bad color. And you can see here that on the left, we have the market crash of 2020, where this immense decline has occurred, down, down, down. And this is what our analog is going to be about in a few minutes. But what I've done is I've put below it two volatility indicators that we use often, especially average true range. And this is average true range 10 period. And you can see this is sort of the area that it operates in, really never getting above 60. And so this was the climactic surge, selling climax of early 2018 into February. Here is the climactic surge of December of 2019. And both of these produced a bump in the average true range, which demonstrates, in fact, that selling climaxes are quite volatile affairs. And then here you can see that the immensity of the volatility that we have experienced in this current decline is far exceeds anything that we've seen before. So in this area here, you can see that we've gotten all the way up to the area of, let's blow this up, 166. And with the VIX up to a record, I believe, of, let's just call this 80. And so and then you can see the VIX in these extremely volatile declines that preceded it. So this is relatively unprecedented. Now, the reason that this is important to us as Wyckoffeans is because of the climactic surge that we get in a selling climax. And this is either the beginning of an accumulation area for a big markup, or it's the beginning of a redistribution area for the continuation of a markdown. And so As of this moment, we can't really make a judgment. We don't even have these conditions yet. We still are in the selling climax mode. One thing I want to show you, let's go back and blow this up again, is that notice that the average true range continues to accelerate, meaning that volatility continues to become greater and greater. We would expect that in a selling climax decline. Same with the VIX. The VIX is just becoming more and more steeply inclined and is even becoming more volatile. And so this is going to go on right until the conclusion of the selling climax. Well, how do we know where that occurs? Well, we get an automatic rally. And so this automatic rally is a very sharp, short advance that is wicked in its volatility, could retrace much of the prior leg down. And you can see here that the volatility here in this illustration just gets more extreme all the way down. Well, then the volatility on the way up is pretty close to equally as dramatic. It's really, for most traders, it is very unnerving, this volatility. And we want to keep in mind that the volatility remains high all the way through phase B. And then once we get into phases C, D, E, we start to see the volatility really dry up. This can take a long time. So this is one of the reasons that I'm counseling for the completion of a cause. Let's make sure that we have a complete cause prior to an important advance where we can count the point and figure across, get an estimate of how much potential there is in the advance, and so on. And so the other thing is, keep in mind always that at the top of the automatic rally, we want to draw a resistance line. At the bottom, we want to, at the selling climax low, which we only know after the automatic rally has started, we draw a support line. Doesn't mean that the market can't go through those, but they ought to be relatively bounded by those two extremes as we go. Okay, well, I'm already using way too much time, but that was really an interesting illustration. This is an analog of 1962. And honestly, this came to me as somewhat of really a dream. It was sort of in a dream state. There was just this voice, saying, go look at 62, go look at 62. I've studied this market in the past and hadn't really thought much about it. But then all of a sudden I'm being reminded, go over here and look. Well, notice this, that we have in 62 a broadening formation. And the broadening formation begins with the conclusion of an important rally into a buying climax in 59, and then an automatic reaction. And so thereafter, the swings in the market just keep widening. And so from the buying climax to the shakeout low, it's about 1,057 calendar days. So this area is pretty substantially large, more than 2 years in duration, close to 3 really. And so at the sign of weakness low here, after undercutting the automatic reaction, there's a very, very good rally that takes over a year to form, and this rally goes into a throw over and an overbought condition with two surges here and here. And these surges you can see this beautiful distribution type structure and a last point of supply right here, which produces a big waterfall decline. And this is a dramatic decline of over 27% at the extremes. So this is a really jolt of a decline, and it goes very, very quickly. Well, if we look at the current market has much of the same characteristic or attributes of this 62 market. By the way, the 62 decline was kicked off by a speech that JFK made really chastising the steel industry because they broke a deal with labor that they had made and raised prices. So this was kicked off, but you can see that distribution was really already complete and it was ready for a decline. Now down here, we have the same structure, shorter in time, but I've stretched it out so they match. And at the point where the waterfall decline started, which is right here, and then right here, you can see that both of them just get busy and start to really go down. Now, the percentage decline in the current market is actually much greater than the, not much greater, it's a little over 30%. So it's somewhat greater than the decline in 62. But there's some lessons that we can learn from this that we want to keep in mind. And that is, well, first of all, these patterns have eerie similarity. So they're quite interesting in their orientation to each other. And also the other thing is you can see here with this severe decline that the shakeout here, what I'm calling a shakeout of the sign of weakness low, doesn't get down to the declining trend line that is established at the automatic reaction and sign of weakness lows. So it doesn't quite get there. But here we have the same structure, automatic reaction, secondary test, sign of weakness, and then we have this really good rally that occurs from December 2018 right up into February. Well, these two rally phases in 60 to 62 and then here are very close in duration to each other. And so this this rally and this rally really do have similarities. And I'm going to look at the point and figure counts in a minute and show you how I counted this area here in the current structure compared to how this was counted. And this count here worked really, really well. So here we are now. As of yesterday, the decline with at the extreme, now this isn't how the market closed, but at the extreme, the Dow Industrials went to and through for the first time this downward sloping trend line and took it out. So we then had a condition here where we had a throw under and an oversold condition. Now that can persist for a while, and it may be that there's still more to go. We know that the volatility, which we just saw in the prior chart, continues to remain extremely high and is accelerating. So it's really very difficult to predict when you're going to have a selling climax low. You really only can know for sure when you get that automatic rally, which is really quite dramatic. And so we don't have that yet. And that is only the beginning of cause building. And so this is really important for us to keep in mind, is that we want to keep our powder dry until we have a cause built. Now let's go back to the 62 example, because we can see here that there is a really dramatic rally that occurs and then a secondary test. And here in this lies a cause. And so you can see that even in a fast moving market like this, where there's a rally and then a really good reaction, that test represents the completion of a cause building process that then produces an important rally. So how do we count this from a point and figure perspective? Well, let's blow this area up. Okay, so this is our point and figure chart of that 62 period. And you can see the distribution count right here went down and counted to the minimum objective range, went right to it. So it did a really good job of counting down to the conclusion, and this is the big waterfall decline. Then after that, it builds the cause, which produces an important rally, and you can see the cause shows up nicely here. But what we did is we counted across here from the shakeout low to the sign of weakness low, and we counted this whole area here and counted across, and from this count low of 530 and then the average of the middle of the range, we get a count 930, 1025. So that is a really sweet advance, substantial in that it's not quite a double, but here this is actually the first time that the Dow exceeds 1,000, which is in 1966. And so, and then it didn't stay above 1,000 until 1982. So this was the beginning of a long period of a giant trading range. But this rally here was substantial. And so is it possible, the question that we're asking is that can we, and here's the count area from here to here. And so is it possible that once this area, the shakeout low, and a cause is built, because we need to see an automatic rally and then a cause built for another move, that in fact we could have a market where it goes up substantially and into a new uptrend, and that this area here, we would want to count this. Well, I contend it's a little too early to count this point and figure yet, because we don't have really the completed accumulation, the completion of a cause build over here like we did in 62. But this is substantial, and it follows the same, really the same guidelines or rules that we followed with this example. And so we're going to keep a close eye on this, and then we have to see the evidence. We never try to predict really in Wyckoff. We just look for the market to tell us what the conditions are, and then we follow them and try to read them as accurately as we can in the moment. So with this in mind, let's see, is there anything else? Well, what are the reasons why the market could take off and have another good leg up, another bull leg, similar to what happened in 62? Well, John F. Kennedy, when he came into office, he did some things to stimulate the economy. He lowered taxes, etc. And this really did take the market and set up the conditions for another good leg up. Well, we have here, think of all the things that have happened since this waterfall decline has occurred in 2020. The Fed has lowered interest rates substantially, I think 1.5%, took them to the zero bound. They've committed to $1.5 trillion of stimulus, including QE, and then also they have been there's a big fiscal package that is coming out of Congress that could be, looks like it's about a trillion now, but it could become 2 trillion. So they're just throwing all this stimulus and liquidity at this market. And we know that once the COVID-19 virus drama, which is really tragic and very difficult for us economically to get through, once the world recovers from that, that all other countries, including the EU, the ECB is just committed to 750 billion of stimulus in euros for their market. This is all liquidity that's going to be resting out there, and the market isn't going to want to go invest in zero bounded bonds. It's going to focus on the stock market, I think. And so once we see some light at the end of the tunnel with the coronavirus COVID-19 situation, the market is going to change its nature. So, and there's a huge amount of liquidity that's here that didn't exist before this decline happened. Okay, so I'm running way behind, but anything that we don't get done here, we'll pick up next week. And I just want to show you here, this is the 62 up to 66 advance, and you can see here right there is where the market went to 1,000, and this is the area that we just evaluated right here. And So you can see that this big, and here's the rally phase up to the original buying climax. And so you can see that this does have a lot of similarity to the condition that we're in now. And so we can, you know, and I'm hopeful for the economy and for all of us and our jobs and our health. And I pray for ours and our families' continued good health, and for those that are ill, that uh, they, whoever we are, have quick and mild symptoms and quick recoveries. So with that in mind, you can see here that there's something that's good that could come out of this current situation that we're in. Okay, now let's look at these point and figure charts. So the area, let me go back here. This area right here is counted to this area across for a point and figure count, which is what we counted here. So this, we're saying, is the distribution structure that led to the decline. And here it's just a little bit more noticeable, let's say, or follows a maybe a more traditional pattern. But here, this continues up into an upthrust after distribution, then a failure. So let's count this. So we count across here, and the count that we get takes us to 2300, 2050. Well, as of yesterday, and the throw under of the trend line that we just looked at, we can see here that it went to 2280.52. This is on the S&P, and so it went through the 2300 area, so we could put an entry here, but it didn't go down to 2250, but it fulfilled the minimum price objective of this count area. So that's very interesting. So it is in the count objective zone. Okay, and here, this is the Dow. And so you can see in the case of the Dow, which is what we just looked at, this is the area of the count across here. And this takes us down to 19,750, 17,250. And we are in the area of, oh, we went to 18,917 at the low yesterday. And this took us to the count into the 19,000 entry on this point and figure chart, which puts us right into the count objective zone. So, and look at this, 9,750 points of objective counted across this area here. And this is basically daily data, 3-box method, and then 250 point scaling. So user defined scaling in this case. The prior one with the S&P was traditional scaling. So we are now in the count zone, but again, we need to start to see evidence of the market wanting to find support where we are. I want to talk about this because this is stocks above their 200-day. I'm going to wait though to do this because till next week, because this is a great way to identify causes. So I'm going to come back to this. And so with this, let's change gears and let's go to the sector work. So we have some time left and talk about sectors, because to me, a bear market in a sector is when it's below a sector is below its declining long-term 39-week moving average. And in this case, you can see that each one of these is below a declining, just starting declining 39-week moving average, except for maybe the utilities. And so we have 11 sectors here, and each one of them is turned down. So with that, confirmed downtrends in price, what do we do about that? How do we find ideas? Because we want to build a shopping list. Well, we turn to relative strength. This is the way I do it. So in the case here, you can see that I put relative strength. These are weekly bars here, and you can see that consumer discretionary is down on a relative strength basis, but communication services are in an upward trend on relative strength. also technology continues to be persistently relative strength wise leadership. And so this looks really good. Industrials, the economy is clearly slowing, going to be in a recession. Industrials look weak, materials look weak, energy's weak. Staples look terrific, and they're acting really, really well, as is healthcare and utilities. So these are the areas that we would want to favor. And what I do is I pull these up and look at them after being in candle glance. You can see here this beautiful area of accumulation in relative strength and leadership pulled back into early 2020, and then it's now just gone vertical, and you can see a really good bullish bar this week in consumer staples. And so this is the way we would want to drill into the individual groups from that and look for best ideas. And so with that in mind, let's go to, here is, we have a few minutes, let's go look at, this is drug retailers. This is fascinating because this is a downtrend since 2015. And so this is an industry group, and you can see here there's attempts to get out of the range channel of the decline, but it fails. But now notice what's happening. Look at this great bar that we have this week, where this is as of yesterday, where you can see that it didn't get to the lows of the prior week, and it's turning up and trying to pivot into an uptrend. And then also notice here the attempt to turn up into an uptrend on relative strength. So this could be early emerging leadership. We want to see it take out the supply line, supply downtrend channel line here, and show that it has the strength to be a leader. It only was able to do this since 2015 one time, which is right here. So with this, let's just keep going. I encourage you to go in and look at the individual stocks. This is food retailers. Look at this. Look at the leadership of food retailers, and then it just goes vertical. Look at this great bar that occurred this week, where it's near the highs of the range against a market with continued selling climax volatility. So this looks terrific, and this uptrend is just really casebook classic. Another one, look at this. This is non-durable household products. Look at this bar, a very wide-ranging bar near the top of the range, and is back up to the long-term moving average. So this looks terrific, and the relative strength is just screaming. So leadership here, and the idea is that leadership will just continue. Here's personal products. Look at this beautiful base and relative strength. So this could be the emerging of something very large, possible accumulation structure, and this could be the beginning of new leadership after being in a downtrend since 2016. So let's see, do we have time to do one more? And so, oh, this is one I really like, Brewers. This is fascinating. This is like green shoots kind of stuff, but higher low from last week. Look at an attempt to crowd into the relative strength. We got to give this more time and see if it can start to turn into an uptrend. But again, we're just watching because we don't have the cause build in the market. Okay, everybody, thank you for being with me. Stay safe, be well, and we will see you again next time.